All right, you guys, my clock says 6:30, so let me introduce myself. My name's Chris Haw, attorney out here in Lakeway, Texas. I will be your humble presenter for tonight, and if you're ready, let's get started. Some logistics items for tonight. Please feel free to submit any questions that you've got during this presentation through the chat function. Go ahead and look on your menu and try to find the chat function, because that way I can try to scroll through and find whatever questions you guys have got. I'll try to be as helpful as I can be. I've already got some text in there, so you should be able to find the beginning of the conversation in there. We're also recording this presentation so you can share it and listen to it again in the future for reference. I'm going to ask you guys, if you've got a lot of noise in the background, maybe you've got your TV on or got some cute kids running around, please mute your microphone so that we don't get a lot of crosstalk. Best way to get a question is through chat, so that way I can scroll up and see what you guys got. Necessary disclaimers. This presentation does not create any attorney-client privilege, and it's because what we're giving tonight is really general information. There are a lot of exceptions, especially when we talk about tax law. So I'm just trying to give you guys a general overview of stuff that might apply to you guys. If you've got any specific questions for your case, please feel free to shoot us an email at that email address you've got there at the bottom, info@tcvlaw.com. Okay, just a little bit about myself if you haven't met me yet. My name's Chris Haw, last name H.A., like I'm a funny guy. Been working for this firm about 2-3 years now, board certified in estate planning and probate law. I think of my certifications right now around the end of the year, I'm most proud recently of doing 8 grueling tax seasons as a staff accountant. So if you're thinking about your accountant right now in taxes, send them a nice note, because they're going to be working real hard next year. And a little bit about our firm. So here's some of the contact information about our firm. I really like working here, so I want to rag a little bit about my firm. I think between all the lawyers here, we've got about, oh, Aaron, don't make fun of me here. I think maybe 80 years of experience between all of us. Don't quote me on that. There's our contact information here. We primarily focus on estate planning and asset protection. So we want to be here to help you out. And without further ado, let's start the presentation. So here are the 3 big things we'll be talking about today. We're going to be talking about the new IRA rules for 2020 under the Secure Act. We're going to be talking about the charitable deduction limits for 2020, and then the big item that a lot of people are talking about right now, the new estate tax rules, and planning for the possibility that your estate tax exemption may go down quite a bit in the next few years. Some of the items we won't be covering today, we won't be able to do a full introduction on estate taxes or IRA planning just because of the sheer amount of stuff that we've got to cover tonight, but hopefully we'll be able to do a future presentation and cover those things in more depth. And if you've got questions about those, send us an email or send us a message in chat, and they'll give me an idea of what we want to do in our next presentations. So, first part, what are we going to do tonight? The first part is the IRA update for 2020. So let's talk about required minimum distributions when you own an IRA. When you own an IRA, the general plan is that you put money into the IRA, you get a tax benefit. And then when you leave the money in the IRA, it grows without paying annual income taxes on things like interest, dividends, and capital gains, which is fantastic because then it grows faster without paying income taxes every year. But Uncle Sam is hip to that. Uncle Sam knows, well, I'm not getting any income taxes on your interest, dividends, or capital gains each year. So I'm going to make you take withdrawals from that IRA eventually. What types of accounts have to make required minimum distributions each year? That's your traditional IRA, your 401k, and your 403bs. And Uncle Sam really sticks it to you. If you fail to take your RMD, you owe a 50% penalty to IRS. But there's two special rules now. For 2020, even though you would normally be required to take an RMD, you don't have to if you don't want to. And the second rule is that RMDs don't start for IRA owners until age 72, instead of the old rule, age 70 and a half. Ooh, technical difficulties. There we go. Okay, so if you know that you have to take a required minimum distributions, why do we want to focus on avoiding taking required minimum distributions? And the reason is because when you take IRA withdrawals, that is taxable income to you. Usually you want to leave money inside the IRA and not pay annual tax on interest, dividends, or capital gains. So, as a general rule, you want to delay taking withdrawals from your IRA as long as possible. Let's go through an example. Let me have you focus on this part right here. Let's say Dr. Grant is not required to take a required minimum distribution in 2020. His filing status is married, filing jointly. He has taxable income of $80,000. What tax bracket is Dr. Grant in without taking an RMD? What tax bracket is he in if he only has to realize $80,000 of taxable income right now? If you see your chat box, I'd like to see your answers. I'd like to see what tax bracket you're seeing him in. Let me give you a little help here with the tax bracket table. The way to read the tax bracket table is if you have no income to $19,750 of income, you're in the 10% tax bracket. For every dollar that you make between $19,750 and $80,250, you're in the 12% tax bracket. And then if for every dollar you make over $80,250 to $171,000, you're in the 22% tax bracket. I've got one answer that Dr. Grant is in the 12% income tax bracket. Anyone else?
Wow. How do
I've got one answer for 22. Margaret, Joanne, Jim, thank you for giving me some answers. I really love to see your answers. I was really mean with the example. He has taxable income of $80,000. He is in the 12% tax bracket. He's almost at the 22% tax bracket, right? Once he earns more than $80,250, he's in the 22% tax bracket. So he's very close to the 22% tax bracket. So the question for Dr. Grant is, I know I don't have to take an RMD, but if I did, my RMD would be $100,000. If Dr. Grant took, remember he doesn't have to, but if he did take his RMD and he had taxable income of $180,000, what tax bracket would he be in? Please go ahead and give me some answers in chat. I'd love to see your answers. That really helps me see if I'm doing a good job of explaining. Yes, yes. I'm seeing a lot of answers. 24. That's exactly right. If Dr. Grant has $180,000 of taxable income, he is more than $171,000 of income, but less than the 326 So he's moved into the 24% income tax bracket. So that leads to your question. Assume that you are the tax planner for Dr. Grant. You know that right now, if he does nothing, he has taxable income of $80,000. He doesn't have to take an RMD, but he could. And his RMD would be $100,000. Should Dr. Grant take his RMD in 2020, even though he doesn't have to? What do you guys think? I got one answer, no. Jim, really appreciate the answer. I got a no if he doesn't need the income. I've got a no unless he needs the money. Guys, yes, that's the first step of the analysis. That's very good. Sabrina, it depends on what his life circumstances are. You guys are exactly right. You guys are doing great tax planning. The general answer is, if you don't have to jump into a higher income tax bracket, you generally don't. So that's why this new RMD rule is so good for a lot of clients, because they say, if I took the RMD, it might shove me into a higher tax bracket. And you look at this jump. To jump from 10 to 12% is not a big deal, right? The jump from 10 to 12, I'm not going to lose any sleep over. But if you jump from 12 to 24, that is a pretty big income tax bracket change. So general rule, you don't willingly go into a higher income tax bracket. There might be exceptions, like you guys pointed out in chat, which was really good. He might need the money for, say, a house down payment, or he might know that he's in a temporarily low income tax bracket, and he's going to be in a much higher income tax bracket for the foreseeable future. So you guys did a really good job in the chat. Great answers. So IRA phase 1 complete. So I'm going to draw a distinction for you guys when we talk about RMDs. There's RMDs for people who own IRAs, and there's RMDs for people who inherit IRAs. When I say owner, I mean the person who opened the IRA and the person who put the money into the IRA during their lifetime. That's what I mean by the IRA owner. You're the person whose blood, sweat, and tears created the money to go into the IRA. But there's another type of RMD, and that's the person who inherits the IRA. That's the person who, they didn't put the money into the IRA, but because the owner died, they received the IRA. And this person has very new rules. So this person, the old rule used to be that if you inherit an IRA, you can spread out the withdrawals over your expected lifespan. The IRS has a table for that. But the new rule is much meaner now. It says, look, regardless of how young you are, the general rule is that you have to empty an inherited IRA in 5 years. You got to do it in 5 years. Doesn't matter how you do it within the 5 years, but you got to do it in 5 years. If you've got good beneficiary designations, if you set up your beneficiary designation on your IRA correctly, you can do a 10-year withdrawal rule, which is what we really want for our clients. Given the choice, if I know I have to empty my IRA, I would rather empty it over a bunch of different years to avoid jumping into a higher tax bracket versus taking it all out in 1 year and skyrocketing to the highest income tax bracket. So the general rule is that you've got to empty an inherited IRA in 5 years. The exception, and this is what we want for all our clients, is if you name the correct beneficiary, the tax lingo is designated beneficiary, or you have the right kind of trust, you can spread out the IRA withdrawals over 10 years. There are some exceptions, say a minor child or a disabled child, but the general rule is 5 or 10 years. Let me give you an example to see how important this is for reducing your income taxes. Okay, let me break this up into parts. You've got your client is Dr. Jones, and he's single, and he wants to stay in a low income tax bracket. Don't we all? and he inherits a $1 million IRA. Should he withdraw his IRA over 5 years or 10 years, and why? So let me now look at the chart in the middle of your screen right here. Dr. Jones inherits a $1 million IRA. Let's say he says, you know what? I want to spread these withdrawals evenly, so I take out the least possible amount each year evenly. If he withdraws his $1 million over 5 years, he's got to take out $200,000 a year, right? $200,000 a year times 5. But if he takes his IRA withdrawal over 10 years, he can spread out the withdrawals over 10 years, so he only has to take out $100,000 per year. Go ahead and take a look at the right side of the chart right here. If he takes out $100,000 a year, what income tax bracket does that put him in? If Dr. Jones takes out $100,000 per year and he has $100,000 taxable income, what tax bracket does that put him in? I've got 24%, 24%, 24%. Exactly, very good, right? Because if you look at the tax bracket chart, $100,000, the 24% tax bracket starts at $85,000 and it ends at $163,000. So if he has $100,000 of income, he's in the 24% tax bracket. Now, the next question is, what if Dr. Jones is unlucky and he has to take out $200,000 out each year? What tax bracket is he in now if he has $200,000 of taxable income? I see 32, 32, 32. Yes. Yes, Margaret, Paula, Jim, very good, exactly right. Because the 32% tax bracket starts at 163 and ends at 207. So he's right there kind of in the middle. So you see, if you can withdraw your IRA over a lot of years, you can spread it out over 10 years, you can get into a much lower income tax bracket. If you have to withdraw your IRAs over a very compressed time span, you might be pushing yourself into a much higher income tax bracket. So when you are setting up your beneficiary designations with your financial advisor, you want to make sure that your beneficiaries qualify for the 10-year withdrawal window, not the 5-year. So that way they can get the inheritance from you and pay as little income tax as possible. You guys, you just did it. You did a great job on the IRA section. Really happy to see your answers here. So we're going to go to the next part here, which is charitable giving in 2020, because we got a new rule for 2020. Okay, so let's do an overview for charitable contributions in 2020. The general rule for charitable contributions is that you have to have enough itemized deductions to itemize your deductions, which I mean is, oh, excuse me, let me go back. You have an option when you do an income tax return. You can take the standard deduction, which is just an automatic amount that IRS sets every year, or you can take the itemized deduction. If your itemized deduction is bigger than your standard deduction. Now, when you're doing charitable deductions, there is always an annual limit that IRS puts in there. It says, okay, I know what some of you guys are doing. I know what some of you guys want to do is lump all your charitable deductions into 1 year and take them in that 1 year and have no taxable income. Fair enough. But Uncle Sam is hip to that. So he says, okay, no. There is a limit to your charitable deductions every year. That normal limit is 60% of your adjusted gross income. 60% of your adjusted gross income. But my friends, in 2020, we got a special rule. The special rule is that for this year only, you can deduct 100% of your adjusted gross income for charitable deductions. So if you were thinking about making charitable deductions, this might be the year to put your deductions in. You might want to make most of your deductions in 2020 instead of spreading them out over 2020 and 2021. Let me give you an illustration because I know that's a little abstract. Let's say in this example, Mo has an adjusted gross income of $100,000. If Mo itemizes his deductions, what is his maximum possible charitable deduction allowed in 2019 and in 2020? So let's look at 2019. Under 2019, he's got $100,000 of adjusted gross income. And in 2019, the rule is 60% limit of adjusted gross income. What is the maximum charitable deduction Mo could make in 2019? I've got one answer, 60. I got another answer, 60K. Jim, I see your 60,000 in the chat. Oh, you guys are going to put me out of a job. You're going to put me out of a job. You're exactly right. So if he has adjusted gross income of $100,000, and the general rule is that you can deduct up to six. I see your answer, Bruce. Your question, Bruce, in chat. And you can only deduct 60% of your adjusted gross income. Then under those rules, your max deduction is $60,000. That's correct. What about 2020? Let's say we're in the 2020 special rules and you have adjusted gross income of $100,000 and your charitable limit is now 100% of your AGI, adjusted gross income. What is the max charitable deduction that Mo can make in 2020 under the new 2020 rules? I see 100,000 from Margaret, 100,000 from Daniel, $100,000 from Jim. Yes, that's exactly right. So you can see the difference here, right? Even though Mo has the exact same adjusted gross income in 2019 and 2020, because of the special rule in 2020, he can deduct a lot more on his income tax return. So in this case, if you're thinking about making charitable deductions, you might want to consider making them in 2020 if you can deduct them, because the limitations are much higher now. But there's one big limitation when you do charitable deductions that we got to consider. So let's consider the difference between itemized deductions and the standard deduction. So, I'm sorry, I love this picture. So you've got Grumpy Cat. Here's our example, Grumpy Cat. He is single. So he's got some deductions here. His first deduction is real estate taxes of $6,000, and he's got mortgage interest of $7,000. So far, his itemized deduction subtotal is $13,000. He's single, so his standard deduction is $12,400. If you can see that over here on the right side of the page. Now, question, you're doing tax planning for Grumpy Cat. You know he's already got $13,000 of itemized deductions from real estate taxes and mortgage interest. Can Grumpy Cat deduct $10,000 of charitable deductions for his taxes, or is it wasted if he makes it in 2020? This might be a hard one for you guys. Let me see what you guys think. Jim asks, what's his income? Let's say, Jim, his income is enough to where It doesn't affect this question. Margaret, you also asked the same question. Great minds think alike. In this case, let's say I've designed the question so his income doesn't affect the answer. Then I've got a series of yeses. Yes, yes, yes. Exactly. You're exactly right. What I'm trying to demonstrate with this question is when you're looking at your income tax return, you're concerned about making charitable deductions when you look at your standard deduction. Because if your standard deduction is bigger than all your itemized deductions, then your itemized deductions are just wasted. So in that case, but in Grumpy Cat's case, his standard deduction is $12,400, but he's already got
We still can't hear you.
okay, I seem to have gotten kicked off.
Only 600 over 13, over the 12,000.
Check, check. Can you hear me now?
Yes.
Perfect. Okay, let me bring up the chat window. Okay, so where we were before was we know in this case, Grumpy Cat is a good candidate to take the $10,000 charitable contribution because his standard deduction is $12,400, but he's already got $13,000 of itemized deductions already. So he's in a good spot to take this $10,000 charitable contribution. But now let me make this meat. Let me change it a little bit. What if Grumpy Cat is married? What if Grumpy Cat is married and his standard deduction is now $24,800? Should he make this $10,000 charitable contribution if his goal is to get a deduction for it? I'm seeing one answer no. I'm seeing two answers. I see four no. You're exactly right. You're exactly right. Because if his standard deduction is $24,800 and you add up this 13 and this 10, the standard deduction is bigger. So in that case, if your goal is to get a charitable contribution deduction, you don't want to do it in this case. So very good. I love your answers, you guys. You guys are smashing this. So we've just covered charitable contributions for 2020. You guys are doing really good. So let's move on to the next part. We're moving on to the last part right here, and this is the doozy, you guys. This is the big one. This is the estate tax rules. So let's go over to estate taxes. When you look at estate taxes, they sound a lot like income taxes. They use a lot of the same terminology, but they work quite a bit differently. So let's talk about income taxes, because those are the things that we're used to seeing. You know, when do you owe income taxes? You know, these are the taxes you're used to owing. You owe them every April 15th, once a year. Income taxes are based on normal income items like wages, interest, dividends, capital gains. You saw earlier in those examples that you guys did so well on, you've got a standard or itemized deduction. Prior to 2020, there used to be exemptions, but they got phased out for just everybody got a bigger standard deduction. And then the tax rate that you pay on income taxes is based on the year that you're in and how much income you earned in that year. So sometimes you have a lot of income, so you're in a high tax bracket. Sometimes you don't have a lot of income, so you're in a low income tax bracket. And finally, the person who pays the income taxes, well, you guys know, it's you. So we're going to make the switch now to a different system, okay? Because we've been talking about income taxes. We're going to talk about estate taxes, often called death taxes. And here's how they're different. Uncle Sam only charges you estate taxes one time when you die. That's the plan. The tax is based on how much you are worth, your assets minus your liabilities on the day that you die, so your net worth. You do get some deductions. You get a deduction for gifts to charity and gifts to your spouse. That's an important one. If you leave gifts to your spouse when you die, you get a deduction for estate tax purposes. Now, here are the parts that we really care about for tonight. Your estate tax exemption in 2020 is $11,580,000. Let's call that $11 million for rounding. Now, here's the thing, and here's why some of you guys might be on this call, is because we know on January 1st, 2026, it sunsets to $5 million, adjusted for inflation. So it might be 5.8 million, 6 million. The way the estate tax works is that it's a 40% flat tax right now. So if you have assets, let's use a simple example. If you have assets of 12 million when you die, and you have an estate tax exemption of 11, you're $1 million over your exemption. So what the estate tax return does is it says you're 1 million over your exemption, you're $1 million too rich, is what IRS is saying. We're going to tax you 40% of that. So 1 million times 40% is $400,000. And the nasty thing is, the person who pays that bill is the executor of your estate, but really, in reality, it's whoever your beneficiaries are, because they receive less from you because your executor's got to cut a check to IRS before he writes any money to your beneficiaries. So at 40%, the estate tax is a pretty nasty tax, because you saw the income tax brackets, the highest one was 37%. Estate tax is 40% from the get-go. Let me walk you guys through an example, okay? Let's say we've got Mama Texas, and she dies in 2020. She's got $7 million of assets. So let's start on this line one. What are all her assets at debt? $7 million. Now, does she have any liabilities or expenses when she dies? Let's just say no. For this example, keep it simple. Call it no. 0. Let's say for this case, she leaves everything to her kids in equal shares. So she has no transfers to charity, and she has no transfers to a spouse. She has an estate tax exemption of $11 million. So her net worth is 7, but her estate tax exemption is $11 million. How much does Mama Texas owe if she dies in 2020? How much does Mama Texas owe in estate taxes if she dies in 2020? I've got a 0, I got a 0, I got a 0. I got a double 0, Paula, that's very good. I like that. I like telling IRS I owe them double 0. Yes, you guys are exactly right. You guys hit it out of the park. You saw exactly. She's got an exemption of $11 million, but her net worth is under $11 million. It's an over-under rule. She's under. So as long as she's under that $11 million, no estate tax due. And that's perfect. That's what we want for our clients. We don't want you to owe anything when you die. And this is the common case for a lot of clients because the estate tax exemption has gone up so much compared to what it used to be. Let's take a walk down memory lane and see what it used to be. Take a look at this chart over here. Here's a summary of what the U.S. estate tax exemption used to be. I think some of you guys remember this. Some of you guys might remember this. Back in 1986, the estate tax exemption was only $500,000. For a lot of clients out here in Lakeway, you've got a house and you've got an IRA, you're easily over $500,000, no sweat. So back then we saw a lot of clients, you automatically had a mandatory bypass trust. You automatically had a life insurance trust. You had a lot of people having to do pretty sophisticated planning, like family limited partnerships to avoid taxes because the exemption was so low. And to make things worse, Texas used to have an inheritance tax on top of that. That sounds really un-Texan to me, to owe taxes when you die, but it used to be there. But now look at 2020 and 2021. Right now, we've got an estate tax exemption of $11.58 million. So a lot of clients have a lot of breathing room. 2021, it's going to go to 11.7. But here's the rub, you guys. Under current law, if no laws change, it sunsets to $5 million, January 1st, 2026. There'll be an inflation adjustment, so let's call it 5.8, call it 6. But for a lot of people, that's going to be a nasty surprise. And then on top of that, I won't name parties, but certain congressional plans are talking about reducing the estate tax exemption before 2026. They're not even going to wait. And they're talking about, some of them are talking about 3.5 million with an inflation adjustment. So where does that really put us? For a lot of clients are going to be in this situation right here, where under current law, you're not really worried about estate tax. I mean, your husband's got $11 million, your wife's got $11 million exemption. $20 million exemption combined, no big deal. But remember, they could really pull the rug out from underneath us, right? If the sunset happens, you're looking at 5. If certain congressional proposals pass, you're looking at 3.5. So a lot of people might owe estate taxes if the rules change. So what are we going to do about this? What do we do? There's one nice thing. The IRS has confirmed they're not going to do a clawback. What do I mean by that? It means if you use your estate tax exemption now in 2020 or 2021 before the laws change, then it's still okay. They're not going to undo those transactions. So as long as you use it now while it's valid, you're A-okay. So for purpose of this presentation, we've got 2 ideas. Idea number 1, let's go ahead and transfer some money to our kids now. Well, we've got this big estate tax exemption. We want to use it before it's taken away from us. Or option number 2, you might be seeing this on Google or your financial advisors now. It's called a Spousal Lifetime Access Trust, or a SLAT. And we'll give you some examples for that. So let's dig into the weeds, you guys. Gifts to children. Idea number 1. You might say, oh, okay, well, here's the thing. I want to reduce my net worth before I die, right? Because remember Mama Texas, she's got $7 million. Let's make that $7 million smaller before she dies. You could give gifts to your kids to reduce your net worth before you die. A lot of you guys already know this right here, already anticipating what I'm going to say. But you say, Chris, I know that I can give $15,000 a year per person and not pay gift taxes. But if I give more than that, I have to file a gift tax return and I owe gift taxes, right? Isn't that what happens? There's an exception, my friends. You get your CPA to file the gift tax return, but you say, hey, look, I've got an $11 million estate tax exemption. So I've got an option. I make this big gift, and it's more than $15,000, right? So the exclusion's gone. It's a big gift. I have two options on that gift tax return. I can choose to pay gift taxes, which is horrible. It's terrible. That's very painful. Or you say, you know what, Uncle Sam? Instead of making me pay gift tax, why don't I just use up my $11 million estate tax exemption? Just use up some of that stuff, because you're going to take it from me anyway, right? And then you don't pay gift taxes. Let me give you an example. Father says, you know what? I like that plan. I want to reduce my net worth before I die. So he's going to give $1 million to his daughter, Annie. Now, for our purposes, assume that he's already given $15,000 to her this year already. So that $15,000 annual gift tax exclusion is gone. You don't use it. Father has an estate tax exemption right now of $11 million right now. Can he avoid paying gift taxes on the gift to Annie? Yes or no? What do you guys think? I've got a no. I've got a yes. I've got a yes. I've got a yes. The answer is yes. Because here's what Dad is going to do. He's going to call his CPA or shoot him an email and say, hey, I just gifted $1 million to my daughter, Annie. And I know that's over the $15,000 annual exclusion. What I want you to do is file a gift tax return that says, I don't want to pay taxes on $1 million of a gift. Instead, take my $11 million exemption and use up $1 million of it. So now my estate tax exemption is 10. It goes down to 10. Dad is not too concerned about this because he expects Uncle Sam to take his estate tax exemption anyway. So we might as well use it up before he dies, before it gets taken from him. So that's the theory there. When you make a gift that's more than $15,000, you have two options, and I'm always going to recommend option 2, is you can pay the gift taxes now, or you can say, Uncle Sam, I've got this $11 million estate tax exemption. How about you just reduce that? Use that up, because you're going to take it from me anyway, right? So I might as well just use it up before it disappears. Now, we've done some good tax planning for Dad. So I'm going to raise a non-tax issue. I know we've been talking about income taxes all night. So I just want to throw in one non-income tax issue here, which is assume Dad gives his $1 million to Annie. No problem. The CPA files the gift tax return and tells IRS, no problem. No problem. Don't make my client pay gift taxes. He's just going to use up some of his estate tax exemption. No problem. But now that Annie's got that $1 million, can her creditors seize that $1 million from her? What do you guys think? I've got a yes, I've got a no, I've got a yes. Margaret, I appreciate your honesty. Don't know. I've got a no. This is kind of a loaded question, I confess. The answer is probably. How would they know that she has it? That's a great question. I'm assuming like a car accident, like she gets into a fender bender and it's some millionaire. So they sue her, and then in the discovery, they find out what her balance sheet is. So then they find out, oh, you've got $1 million. The reason I asked these two questions at the bottom of the slide is that even though for tax purposes, giving gifts to children might be good estate tax planning, you typically don't want to give the asset to the child outright. You can put it in an asset protection trust so that if she gets sued, the trust is its own separate entity it didn't cause the car accident. It's not involved in the car accident. So when they try to sue Annie, the trust is very hard to breach because it wasn't involved in the accident at all. So it's very hard to take assets out of that trust. So I'm really glad to see all your answers, you guys. Margaret, I love your answer. Don't know. So honest. I appreciate that. Okay, so we've just talked about gifts to children. Now let's talk about spousal lifetime access trusts. Okay, so you might say, Chris, I love my kids, but I don't want to give them all my assets right now. I mean, they're mine. So you might say, Chris, you said earlier in the presentation that I get an estate tax deduction for gifts to my spouse, right? Didn't you just say that? So why don't I just give everything I have to my spouse so that when I die, I get a full deduction and I don't owe anything when I die? That's true. If you leave everything to your spouse at death, you won't owe estate taxes. That is absolutely true. But here's the trap. This is the IRS trap, is that if you leave everything to your spouse without additional tax planning, she's become a whole lot richer. Now she owns all the assets. And you know what? Uncle Sam wants to reduce her estate tax exemption as time goes by. So what they really want to do, they'd really prefer that you leave everything to your spouse without any estate tax planning, so that she's holding all the assets, she has a small estate tax exemption, and then they just stick her with a 40% tax. Well, that doesn't sound so good. So what do we do about that? Because I don't want that to happen. That's where the Spousal Lifetime Access Trust comes in. It's designed to achieve some goals, which are, you may not want to give your assets to your kids or your charity just yet. It's your stuff, you want to hold on to it. But at the same time, you're concerned because you know the estate tax exemption might be falling in the future, and you want to use it up while you've got it now. So I'm going to explain the SLAT trust in the next few slides. It's not for everybody, but here are some of the people who might consider it. If your net worth is over $10 million right now, because we're planning on the sunset to $5 million. So it's $5 million for the husband, $5 million for the wife, so you've got $10 million combined exemption. Or you might consider a SLAT if you expect Congress to reduce the exemption soon, or if you have assets that are likely to appreciate over 10 million. Excuse me. So I know that's a little abstract. So let me give you an example. Let's demonstrate a spousal lifetime access trust. I've got three kind of segments here. We've got segment 1, we got segment 2 in the middle, and then segment 3 over on the right. So here's kind of how it works in a nutshell. You've got Rick, he's the husband. He says, yeah, let's do this SLAT thing. Let's do this SLAT trust. I think it'll be really good. So what he's got to do is he creates a marital property agreement, and he says, I'm going to create separate property of $1 million. And I'm going to transfer it to a spousal lifetime access trust for my wife. Excuse me. So usually what we learned earlier is that usually when you gift assets to somebody, you trigger gift taxes. But we know that Rick has an $11 million estate tax exemption. So he tells his CPA, look, go ahead and use up my estate tax exemption. So that way, the transfer of the assets does not trigger gift taxes to me. So this transfer to the SLAT trust doesn't trigger gift taxes. Now, let's move to section 3. Take a look at the SLAT trust and how it's designed. The trustee, the signer, is Elsa. She controls the trust. She writes the checks on the trust checking account. The trust is written so that she is the beneficiary of the trust. She can take distributions from the trust for her benefit. And then when she dies, the trust goes to her kids or whoever they decide it wants to go to. the trust is designed with some specific features here. It does not belong to Rick when he dies for estate tax purposes. It does not belong to Elsa at her death for estate tax purposes when she dies, because it's his own trust. So when Rick or Elsa dies, the SLAT trust doesn't belong to either of them for estate tax purposes. But at the same time, it's designed in a very kind of tricky in the sense that because Elsa is the beneficiary and she controls the trust, she can let Rick benefit from the trust assets during his lifetime. Okay, so I know that was a lot. Okay, so let me break this into questions and see how well we're coming along. Let's do the first question on this SLAT. When Rick contributes $1 million to the SLAT trust, does he owe gift taxes on that transfer? I've got to know. I've got to know. I know this is hard, you guys. I really appreciate your answers. I've got 4 no's. You guys are exactly right. That's what we covered before. Rick knows that usually when you give big gifts to somebody, it triggers gift taxes. But he's already thought of this because he knows I've got an $11 million estate tax exemption right now, and they're going to take it away from me, right? They're going to reduce it to 5 or 3.5. I might as well use it up now. So he tells his CPA, go ahead, use up my estate tax exemption because I'm going to lose it anyway, right? Let's use it up now. Very good, you guys. Really glad to see those answers. Here's a harder question. At death, does the SLAT trigger estate taxes for Rick? When Rick dies, does the SLAT trigger estate taxes for him? I've got 2 no's and a yes. No. I got another no. Jim, do you work for IRS? I'm teasing you. The SLAT is specifically designed so that Rick has no ownership interest in it, right? He's not a signer for it. He's not a beneficiary of it. It doesn't go to him. So we designed the SLAT trust so that what Rick has done in this case is that he's moved $1 million of stuff out of his name, and it doesn't belong to him anymore. And he did not have to pay gift taxes to do that, which is the beauty of the SLAT trust. So now he doesn't own $1 million of stuff, but he benefits from it. Let me ask the harder question. I'm not really expecting you guys to get this question, but let's see. For Elsa, let's say Rick is already deceased, and now we're talking about Elsa. Elsa is running this SLAT trust, and then she dies. Oh, that's a good question. I'll get that. So Elsa dies. Does the SLAT trust belong to her when she dies for estate tax purposes? I got 3 no's. That's exactly right. A 4th no. That's exactly right. We've designed the trust so that there are enough restrictions on Elsa so that it's treated as though it does not belong to her for estate tax purposes. So that's the beauty of this structure, is that if you do it right, it doesn't belong to Rick for estate tax purposes. It doesn't belong to Elsa for estate tax purposes, but they can still benefit from it during their lifetimes. So that's the idea. That's the planning behind it. Let me go back to that question above. Scroll up in your chat, you guys. You'll see the question. What happens if Elsa precedes Rick in death? What happens if Elsa precedes Rick in death? That is a really good question. So remember how we talked about how this might not be the right plan for everybody? This particular trust the feature that I would put in this trust is I would say, you know, you got to think about it because this particular trust doesn't make Rick a beneficiary if Elsa dies. So you have to think about whether you're okay with that. So you raised a really good issue, and that's why I'm only giving you the general structure. We have to have a specific consultation to see if this fits your case. But that's the general structure of the SLAT trust right there. That's a really good question. Whoever asked that question, you jumped like 3 steps ahead. That's usually part of the consultation with the attorney. That's a really good question. You know, we've only got 5 minutes left. So I'm not going to take you through these case studies, but what'll happen is we're going to publish this online so you can get all the slides. What I'm going to do is jump down to some of the downsides of a SLAT trust because it's not for everybody. So these are some of the issues you want to consider. If you do a SLAT trust, you want to contemplate a divorce. You want to think about what assets go into the SLAT trust. And you got to remember that this SLAT trust is irrevocable. So it may not be the right fit for everybody because this is a plan you put into effect. It's kind of hard to change once you've made it. There are ways around it. We don't have enough time to talk about this. There's ways around it, but it kind of binds you in some ways. So having said that, here's what we talked about today. Just to recap, we did the new IRA rules under the Secure Act. We talked about the RMD rules for IRA owners. No RMDs are required for 2020. People who inherit IRAs, beneficiary IRAs, they are under a new 5 or 10-year rule. Charitable deductions for 2020 only. You can deduct 100% of your AGI in charitable deductions instead of just 60%. And for estate tax planning, we talked about gifting assets to your kids before your estate tax exemption is reduced. And also, we talked about spousal limited lifetime access trusts or SLAT trusts. Do we got any questions, you guys? I open the floor. So we've got a question. Would a life insurance trust be a good idea? So Aaron, you're asking a really good question. So one of the things that we weren't able to get to in this presentation is that a lot of times what some people will do is they'll say, what I could do is buy, as an example, just one example, is I could buy life insurance as a way of having money to pay my estate taxes when I die. If I put that life insurance in a specially structured trust, it's treated as though that life insurance doesn't belong to me for estate tax purposes at all. So the nice thing about life insurance is that it has a big leverage component. You pay insurance premiums, but then when you die, you get a big death benefit that might be 10, 20 times more than what you paid in premiums. And if you structure it correctly, that life insurance death benefit won't be subjected to estate taxes, and it can be used by your kids to help offset the cost of estate taxes. As one example,